I love showing this because it simplifies things, and I think we can all grasp it. When we look at the economy, we generally look at it in relationship to growth and inflation. We had been many years in a high growth, low inflation time frame. I mean, I bought a home a few years ago down in Florida, a second home, and I went out and took a loan. I got 2.9% for 30 years. Why wouldn't I borrow that? I'm doing better than that in the stock market. Why would I take that money out and buy the property if I can borrow money cheap? We were living in that environment, right? We were having great growth. The investments are doing well, and we had very low interest rates. But what happened in 2022? We started printing money in the government, $2.6 trillion bill we passed. We threw all that money out there, and guess what? We had no more goods and services that were being produced. So now you got more money chasing the same amount of goods and services, which is causing inflation. That's the result of what we did a couple years ago. And you saw it. We had $9 a dozen eggs a couple years ago, right? Things were getting out of hand. So we moved from here to here. Markets were still doing well. Seemed like people were still spending. It was just more painful. We actually are now moving, not on a straight line, going, where are we going to land here? So we're slowing down in growth. We're going to more of a low growth environment. So is it going to be on this side, low growth, low inflation, or low growth with high inflation, which leads to recession, market stagnation, those kind of terms you hear, those that are out there. We believe we're going here. All the signs are indicating that we're probably getting to the end of this really rapid cycle of growth. We're going to take a breather. We're not going negative, but we're going to be for maybe the next year or two into a lower growth, but yet stable low inflation rate, period. Why does this matter to you? Very simply. Stocks and bonds did very well for us during this period. If you remember us talking to you over the last few years, we didn't want to be holding bonds, right? When inflation kicks up, interest rates are going up, inflation's going skyrocketing up, bonds tank, which they did. Both stocks and bonds went down in 2022. The stock market went down almost 20% for the year. Bonds went down 15%. They hadn't gone down 15% in 45 years because of the rapid increase in inflation and interest rates. Drove the bond market almost out of business in this. So remember us talking about, yeah, we're going to hold stocks, but we're probably going to use cash and cash alternatives. We were getting 5.5% on money market type accounts in your Fidelity account. So we had stocks and cash. We didn't want to be holding bonds that were going down in value. Okay? But now we're kind of entering this phase. What's good about low growth and low inflation? It's more stable, it's more predictable. We can still make money with stocks, but our bonds, if interest rates are coming down and you've bought bonds at higher rates that are existing today, if you believe rates are going to be lower tomorrow, let's lock in some of these bonds, hold those higher interest rates bonds over the next few years. So we're unloading cash and going back into midterm range bonds. We're not getting into long, and I can go into that. But so what we want to try to avoid is being here. Recessionary, stagflation, wherever you would end up, we don't need zero growth or very low growth with a lot of inflation. That doesn't work. That creates recession. And then you don't want to own anything.